Hey friends, Lucian here with the Bullish Bears team. Wanted to make this video on how to read stock charts for beginners. If you're new to our community or following us, we do have lots of resources on our website over at bullishbears.com. If you need more information and help, we have several different courses over there. Lots of resources, and our YouTube channel is a great resource as well. So this video is going to be more like a high-level overview, kind of just going over some of the basics, what to look for, and then again in our courses we kind of take what I'm teaching in this video and go into more depth, because again, it would be nice if trading were just easy, right? You could just look at a few things, it's super simple, and then go about your day. But each part or moving part with trading tells a different story, and it's important to know that story, right? And so when you're trading, it's the whole story of the bulls and the bears, right? The bulls try to push price up, bears try to push price down, and it's that tug of war between the bulls and the bears, which leads me to the first thing I want to talk to you about, which is candlesticks, right? Everything that you see here on this chart are candlesticks. Now, another form of charting that's popular are line charts and bar charts, but it's kind of getting more antiquated. There, you'll see a lot more traders using candlesticks now. They're a little bit more visually appealing. They form patterns that look a little bit nicer than bar charts or line charts. So candlesticks are more of the popular way to trade now, and you'll see green candlesticks are people that or the traders that are pushing price up. These are the bulls. Red candlesticks, traders are pushing the price down. And you'll hear me saying over and over and over in my videos about these patterns are incredibly important when trading. So if you're new and you're like, I don't know, candlestick patterns, I just want to buy a stock. I just I heard on Kramer or I heard on CNBC I should buy a stock. Don't buy. Very simple. Don't buy a stock if you don't know support and resistance. We drill it over and over and over again to those that follow us. If you don't know support and resistance, you need to practice paper trading and getting comfortable with trading first before you ever put money into a real stock. Because these are the areas when you see right up here, this is where people will hear news that, hey, Apple's at all-time highs, and then a new trader will buy, and then a stock falls, and they lose their money. And they wonder why. Well, here's big warning signs. These are candlestick patterns. These are telling you a story, right? Bulls are pushing price up. Apple's at an all-time high, and the next candle couldn't break above the previous high, but you look right over here, here's a resistance level. So price comes down, stock breaks above resistance, right? Support and resistance. This wasn't the previous all-time high. You have a new high here. And when price starts to fail this area here, that's not a good sign, right? Then it kind of gets a pop back up, and now you're forming basically a head and shoulders pattern. And, this is these are all warning signs of what a stock's going to potentially do. Again, you can never predict 100% what a stock is going to do because, all it takes is one trader in the world that does something opposite of what it's supposed to be doing, and they make a stupid mistake or whatever, and it can change the whole course of what's happening. However, support and resistance is formed by candlesticks, and those candlesticks that form the support and resistance level, which also form these patterns, traders are watching these patterns like a hawk. So first and foremost, we are huge proponents of candlesticks. You'll hear us saying it over and over again. We have, again, on our website, an ebook, wallpaper backgrounds, our candlestick courses to really help you go in depth with candlesticks. So I'm not going to go too in depth in this video on candlesticks because we have lots of resources on our website. So next up, we have moving average lines, right? So moving average lines are very, very popular. I'm going to go over some of the most popular ones, but I want to just be very clear that moving average lines are lagging indicators. So very important for, keeping an eye on support and resistance levels. However, candlesticks are still the most important line of defense. Those are instant. That's telling you an instant story between the bulls and the bears, where moving average lines are more lagging indicators. So again, really great to show you support and resistance levels. However, not so great if you want to know more of an immediate impact of what's going on. So you'll see in my chart right here, I have a blue line, This is a 9 exponential moving average, or 9 EMA. The red is the 20 EMA, or exponential moving average. So if you use the 9 and the 20 together, those are very popular. Or there are many traders that don't use the 9 and the 20, and they just use the 13 EMA, which is kind of an in-between between the 9 and the 20. So, popular, are the 9 and the 20 together, or the 13 EMA. So if you use the 9 and the 20, you don't really need the 13. If you use the 13, if you use the 9 and the 20, you again don't need the 13. But if you use the 13, you don't need the 9 and the 20. Sorry, that was like a tongue twister. Maybe confused for a second. Next up, you'll see on the chart here the 50 SMA. Again, you can put these colors however you want. I just like more colorful moving average lines. Other people like more muted colors. Dan likes to have more muted colors on his chart. So again, all a matter of your preference. So this is the 50 SMA. And then this black line right here is the 200 SMA. So if the 50 SMA and 200 SMA are very popular, other traders like to look at the 100 as well. Again, you don't bog yourself down, but the whole point with moving average lines is the further price moves away from these moving average lines, the more it naturally wants to start gravitating back towards it. Right? And this will bring me into another indicator right down here, RSI. It's a real popular indicator to see when a stock is overbought or oversold. It kind of gives you a visual on the chart where it gets above this black 70 line. You'll see these red areas. This is showing it's overextended, meaning price is far away from these moving average lines. Naturally, it wants to come back, right? So when stock is riding these moving average lines, this is a nice move up, right? This is very bullish. But when it starts to falling and going in between these moving average lines, and the moving average lines trade sideways, now it's warning signs. And then you see when they start crossing over and heading down, then it becomes bearish. So when price is kind of riding above the moving average lines, that's bullish. When it starts falling, that's a bearish sign. So moving average lines show you, again, very popular support levels, right? And then when they start to fail moving average lines, then they're resistance levels, right? So price goes up, wants to come back down to support these moving average lines. And then when price starts failing these moving average lines, it starts trying to move back up. And then you'll see price falls, price gets moved back up, bulls try to come in, rejects off moving average lines, comes down, push back up to moving average lines, push up. And then so you'll see, right? These are all bear flags on the way down. So for, a stock like Apple to recover, you ideally want to see price get above all these moving average lines. This is a lot of resistance. That might take a long time to happen, right? So whereas Apple was looking really nice, back in these areas, it's not so hot now, so that's, again, the battle between the bulls and the bears. So you have support and resistance lines with these moving average lines, as well as the support and resistance levels from candlestick formations and the bigger overall patterns that you see, and then just even the smaller ones, right? So there's reversal patterns, and then there's also bigger overall patterns like head and shoulders patterns, and then you have star patterns or evening star patterns, right? So if you're hearing what I'm saying and you're like, what the heck is he talking about? Take our courses. That'll really, it'll help you. I wish there was an easier way to tell you, but it takes a long time. It takes many traders 6 months to a year, and takes looking at hundreds, if not thousands of charts to be comfortable trading. We wish there was a better and quicker way, but there isn't. It takes a lot of work. We tell people and that follow us that, treat trading like an education, right? Treat it like an education, a career. You're going to have to invest lots of time. If you go back to college or you go to college, you don't get a 4-year degree in one semester, right? It takes 4 years. It doesn't necessarily mean it's going to take you 4 years to learn trading, but it might take you several months, a year plus. But again, don't trade with real money until you have successfully paper traded. It's that simple, right? So you have candlesticks, you have moving average lines, RSI, again, a relative strength index that shows when a stock level is overbought, which means, kind of just think of it very simply. Like when a stock goes up, it's going to come back down because traders want to take profit, right? So like when a stock's at all-time highs, like, yeah, like you don't know if it's going to keep going up forever. So you're going to take your profit, wait for it to fall back down to support levels, and then maybe buy back in again. So buy low, sell high, buy low, sell like high, right? But many traders, the new ones especially, come in and they end up buying high because they hear news on Kramer or CNBC or Bloomberg, hey, the stock's super hot right now. They buy high and then they end up, losing money, and then they sell low, right? It's all about support, resistance, and patterns. So down here, you'll see RSI is oversold, meaning a stock is really selling off. So the reverse is true when a price is overextended and wants to come back to the moving average lines. When it's oversold down in these levels, it naturally wants to gravitate back to the moving average lines. Stocks are like rubber bands. When they get overbought and oversold, they want to move back to equilibrium or those moving average lines. So moving average lines are a great gauge. They are lagging indicators. Still, candlesticks are still more important. But those are the most popular, the 9 EMA, 20 EMA, or the 13. So either use the 9 and the 20 or the 13. And then the 50 SMA and 200 SMA. Another popular indicator is Bollinger Bands. If you use Bollinger Bands, you don't really need to use RSI. Bollinger Bands kind of put these bands around candlesticks that show you when price starts moving outside of the Bollinger Bands. Either way, it kind of wants to move back into the Bollinger Bands. So Bollinger Bands are just something that replaces RSI. I don't want to go into super over in depth on indicators because we try to encourage people. You don't really need a ton of indicators, right? RSI, it's a nice gauge. You also don't really need it because you could also say, hey, if I don't have RSI, look at how far price is from the moving average lines. If it's far away, it's going to naturally want to move back in, right? So in either direction, when it's oversold or it's overbought. Volume, also very important. Volume equals liquidity, enables you to get in and out of positions at a much better rate. The more liquid a stock is, the easier it is to be able to get in and out of that stock, and also for better pricing. A stock like Apple, Facebook, Amazon, Google, those will be great for liquidity. But when you start getting into the low float penny stocks, if there's not a lot of volume on that stock, depending when you're trying to get in and out of it, then the spreads get very wide. So this is a spread up here, the bid and ask spread, right? So, right, you can see 2-cent spread. That's a really good spread for Apple. But in low float spreads, sometimes you might see 10, 15, 20 cents or more. That means you're automatically going to be down, 10, 15, 20 cents times the number of shares that you purchase immediately off the bat. So that's where it becomes very, very risky, right? So you ideally want to have volume. The more volume that comes in, the more liquid the stock is, and the more liquid the stock is, the better pricing that you can tend to get. It's not always the case, but that kind of tends to be more the case, right? So you'll see over here, I have my TD Ameritrade watch list and these bars kind of set up. You'll see over here, I kind of have a watch list with my symbols. I'll do my morning scan, our watch list. We do watch lists and trade alerts each night for our followers. You'll see over here percentage change. So you can kind of when you're watching in the morning, when something's moving, you can see, oh, the stock's up 75% on the day. You can see over here, how much volume is there? Okay, that's a lot of volume, right? So, a million plus, that's some really decent volume. But then you start to see a stock down here, like 200,000, 100,000. Now it's a little bit lower. There's not a perfect gauge for volume, but 500,000 or more, maybe the minimum 300,000, depending on the stock. You'll see a lot more with a stock like Apple, but if you're trading these low floaters or these penny stocks, the more you get over a million, the better. And you'll see shares right up over here. That's shares outstanding. That's basically like float. It's not exactly like float. TD Ameritrade just only has the shares button, but it's a good gauge because their shares outstanding is usually higher than float. So you can kind of see the lower the number, the more low float, the more volatile, the more risky. That's when you'll see like a lot more of the pumping and then the dumping. Let's take a look at like, look at this stock right here. SAEX, look at this thing. Piece of garbage, So this is it probably was never 5,000 bucks. It's probably lots of reverse split. So a lot of new traders, this is a perfect example, will come into the stock market and be like, oh man, SAEX, that was $5,000 at one point. Shoot, I can buy that thing at, $3 today. If that thing goes back up to $5,000 again, I'm a millionaire. Not so fast, right? There's a reason why a stock looks like garbage like this. It's pumps and dumps, right? But you can make really good money because when you zoom in on it, look, see now the charts, this is day traders, these are days that are day traders are coming in and scalping it. You can see this chart is garbage compared to a stock like Apple, but there's lots of money to be made if you're day trading, and day trading is, getting in and out within, several seconds, maybe a minute or two. So where you can, buy a stock, let's say 1,000 shares at 384, 380, let's say. If the stock goes, to 390, you make 10 cents, times 100 shares, it's $100. So it all depends on your size of your brokerage account. That's how you could really, that's day trading, right? So swing trading, I wouldn't recommend swing trading a stock that's garbage like this. That's where you'd want to do more of the bigger stocks and then move into more of things like options, or doing options trading. So this is kind of like a higher level overview again. Huge proponent of candlesticks. That's the number one. If I can stress anything to you in this video, candlesticks are number one. Moving average lines and every other indicator becomes more number two. It's secondary basically because they're lagging indicators. So on your chart, you can have, candlesticks, maybe a few moving average lines, RSI, but you don't really need much more. MACD, some people like it. You don't really need it. It's really just need volume and candlesticks at the end of the day. And what will happen is the more you start to learn trading, the more you'll start to you might start off with a whole bunch of indicators and then you'll start scaling them down because you just really won't need them anymore because you'll realize support, resistance, and patterns are just incredibly important. So hopefully this video helped you. Again, head over to our website, bullishbears.com. We have lots of resources over there to help you to become a better trader. So we enjoy having you watch our videos. We're thankful to have you as a follower. Make sure to subscribe to our channel if you're not a YouTube subscriber yet. And we will see you in our community. Enjoy.